Stocks have taken a breather ahead of Donald Trump's inauguration next week, but continue to hold up off their lows. Welcome to the Daily. My name is Jessica Remy, a market strategist here with Moo. Well, overnight we saw the broad S&P 500 move ever so slightly lower, but it is still holding up off its January lows. And big tech stocks slipped, with the Nasdaq 100 down 0.7% overnight. It's now down almost 5% from its December record high. Now, despite the dip, it's really important to note that bullish sentiment is slowly coming back. That's for good reason. We've had two good inflation prints. Bond yields are lower, so too is the US dollar. And plus, we've had the US Federal Reserve Governor Waller, a Fed speaker, come out saying overnight he expects the Fed to cut interest rates multiple times this year. Now, all this is good for stocks. Now, strengthening this narrative, we really critically got S&P 500 company profits results coming in so far better than expected, 10.5% better than expected. In fact, we can see that on the chart we've got on the screen. So far, 23 or rather 34 of the S&P 500 companies have reported results, and we can see sales growth is up 7%, earnings growth is up 24%. So really good stuff, and this is supporting stocks. But as we said, we've only heard from 34 companies so far from the S&P 500. But really critically and wonderful to note that 100% of the companies who reported over the past 2 days delivered eye-watering results, far better than expected. One of those stocks was Morgan Stanley. They reported overnight. Morgan Stanley delivered 31% better profits than expected. The day prior, Goldman Sachs delivering an eye-watering 45% better than expected profit beat. And Goldman Sachs chart is on the screen right now. We can see their shares have considerably gapped up higher for a couple days now, and they are probably worthy of your attention if they're not on your radar already. The big next test for US company earnings will, of course, be big tech stocks, because big tech stocks make up most of the market in the US. Now, have a look at this chart that we're showing on the screen. This is the ETF that tracks the Mag 7 stocks. Now, despite the Magnificent 7 index underperforming, as in not performing as strong as the S&P 500 since the middle of December, we're not really seeing investors cushioning their portfolios or buffering their portfolios should we see a dip or a drop in tech stocks. Now, this basically means there's more bulls than bears in tech. But consider this: if big tech stocks deliver disappointing results, then it probably might be painful and investor fear might rise, i.e. selling might rise. But on the flip side, on January 29, of course, if Microsoft, Tesla and Meta do deliver the goods and they kick off big tech earnings with a bang, then that would, of course, improve tech stock sentiment and probably see this Magnificent 7 index and this ETF that we're showing, you probably might expect that to push on up. So keep your eye on this ETF if you haven't already considered it. Now, speaking of Mag 7, what can you expect? Earnings are expected to grow 21.9% this quarter. That's compared to the 31.3% earnings growth delivered in the prior quarter. As to what to watch today, well, the Aussie share market is expected to close the week higher. So far this week, it's up about 0.3%, but most of the gains have been seen in a couple key stocks. Star Entertainment shares, they're up 22% this week. Ingenia Communities, their stocks up 16%. Really important to note, though, focus really is on commodities for a couple key reasons. Oil is higher for the fourth straight week. It is lower today, down about almost 2%. Oil is currently at $78.68 US a barrel, but it is holding up off its lows. As we said, it's higher. Oil is higher for the fourth straight week. Now, based on the dip that we are seeing in the oil price today, it obviously suggests that you could see buyers emerge in oil and gas stocks. So keep an eye on Woodside Petroleum and Santos just to name a few. Elsewhere, it is really pleasing to see the US dollar continue to fall, and that is supporting higher highs, possibly ahead for copper, aluminium, and iron ore prices. So maybe that might invoke some investor sentiment to see a boost in commodities. As for what else might really inspire more buying, is that we're starting to see more M&A activity pick up in the commodity space. For example, mining giants are attempting to gain more assets and resources, perhaps as much as they can, as the world really is charging ahead to build more AI data centers to power the next generation of technology. We know that Rio Tinto and Glencore are in talks about a potential merger. Merging their businesses would create the world's biggest mining company ever, and it would overtake BHP, and would also significantly, if it does go ahead, become the world's biggest mining deal. So keep an eye on not only BHP but Rio Tinto. Rio Tinto is trading lower today, but do keep an eye on Rio Tinto, as we said, for obvious reasons. But Rio Tinto, importantly, has critically moved into lithium, but they are a large provider of assets such as iron ore and aluminium to the world, and they have a market cap of 103 billion US dollars. Glencore is valued at 55 US billion dollars, and they're just a couple things to watch. Thanks for your company for the daily. My name is Jessica Ramir, market strategist here with Mumu. Stay tuned. We'll give you more detail and stocks to watch next week with the weekly. Bye for now.